What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy Wednesday. Hope you are all doing well out there. Everything is okay in Bitcoin land. Price is going up, ETF flow is going up. Everything is looking very, very bullish. So we are all in a good mood, hopefully. Today, what I want to do is go over the Bitcoin price. We'll go over some macro shifts, some macro developments. I cover that every now and then. And last time I covered that, I said, hey, expect to see XYZ. So we're going to go over that. And then finally, end up with a post that I put out today on bitcoinandmarkets.com. And actually, that's where we're going to jump into first, just as the first thing to hit up on the day. Check out bitcoinandmarkets.com. That someone's riding a dirt bike right outside my window. Okay, so check out bitcoinandmarkets.com. This is where you find all my stuff. You can join the free email list and get all my stuff that is free content posted to you. I also have a premium newsletter there, so you can join that. But let's jump into the charts here. So we have the Bitcoin price. Look at this beauty. Look at this beauty. We have been raging. How far are we off of the recent lows? So this recent low back here, we touched 16%. That's pretty good. I also had a tweet where I put out a good chart. So let me find that real quick and share that one. It has to do with how long we've been in this consolidation. Okay. So you can see this first consolidation here, 31 bars. That was from last March to this time last year. And then this March to now is 32 bars. And so we are ready to go on the next leg up. That's what I'm thinking. Time for the consolidation to end. All right, back to the charts. Let's take a look at some other things. So Bitcoin is just looking really, really good. Let's bring up the EMAs, or the moving averages, above all moving averages. Very, very bullish. Let's go to the Ichimoku cloud, which I put out on the premium newsletter. I talk about this indicator quite a bit, but you can see very bullish for the daily. Everything is checked off. Lagging span is above. Cloud is now green. Price is above cloud, and TK is properly oriented bullish. Even if we go down to the weekly chart, this is also quite bullish. I mean, this was interesting. This bottom here on August 5th hit right on the Kijun, which is the Kijun bounce. But we have a green cloud, price above cloud, TK. I mean, I don't like this flatness of the Kijun, but we did tap it already. So, but TK is in the proper orientation. The only thing we're missing here from this weekly cloud is lagging span, which is hiding under this candle, to be above the price structure. So when we go up, close to all-time high, that's going to trigger the bullish trade on the weekly Ichimoku cloud as well. All right, so those are a couple indicators. I don't know what else to see. You guys can put it in the chat what you would like to see for the Bitcoin price. We can extend out here. So when we were looking at that move from last year at this time, if we trace this move out, say from there to there, okay, and then we move this to now, this is what we're looking at. So by March of next year, roughly being up at 170,000. That's pretty big move. I don't really think we're going to get there by that time, but I can definitely see all-time high by the election, which is coming up very shortly. All-time high before the election, and then 100K by the end of the year. Now, 100K, I think, is going to be a very stiff psychological resistance. So, I mean, a lot of people will probably have sells right around that time, be taking profit. And so I think 100,000 is going to be very stiff psychological resistance. But once we consolidate, I don't think we will necessarily consolidate for 8 months like we did this time. But if we consolidate for a couple months, then only then after that can we, I think, attack some of those higher levels. And it remains to be seen what all the macro stuff is that is going to be affecting Bitcoin in the new year, with possibly a new president, um, possibly with recession coming. All sorts of different things can hit. China's not out of the woodwork, so there are some major things that can occur that we just kind of have to wait and see how 2025 is going to turn out for Bitcoin. But that's the general path of what I'm expecting. All-time high by election, and then 100K at some point in the next, by the end of the year, and then a long period of consolidation, and then one final boost before the end of this cycle. Then we will enter into the bear market part of the cycle. Now, is the bear market this time going to be like all other times? For now that we have deeper markets with much higher open interest everywhere, we have, of course, all these ETF products. We have options coming for the ETFs. And so this is going to be a much deeper market. Are we going to see a major bear market next? Well, that kind of depends if we have a major bull market. If we have a much weaker bull market, then we'll have a weaker bear market. But I still do think that there are going to be these 4-year cycles, at least that you can see when you zoom out. It might not feel like, like this period breaking out from 30,000 almost feels like last cycle already, and that's been a year. So it's going to feel maybe like not really the 4-year cycles, but when you zoom out, you'll definitely be able to pick out some 4-year trends. Okay, so that's the Bitcoin price, but we talk about Bitcoin and macro here, not Bitcoin and crypto, but Bitcoin and macro. Let's talk a little bit about the dollar. So the dollar was coming off of this bullish divergence. It is now overbought, but a lot of people have been saying, who saw this coming? Who saw the dollar making this type of rally here? We talked about it down here. I was surprised that it was this low and it would need to return. I've been saying the whole time during this whole post-COVID era that we would be range bound, and we are pretty much the definition of range bound here on the dollar. The dollar is not going to weaken dramatically. First off, the DXY is measured against other currencies, other government currencies. I don't want to say fiat currencies, because if you guys know my content, I don't even think we have a fiat currency right now. We have a credit-based currency. And even Mises had a difference between fiat, commodity, and credit-based money. We are credit-based money. Mises would say we are credit-based money. He would not say we are strictly fiat money. So anyway, the DXY is measured against other government currencies. And since the dollar is the global reserve currency, as we approach recession, dollars become short, credit becomes short, it's tight money. And so then the value of the dollar relative to those other currencies will rise because everyone has dollar denominated debt. They all need dollars to service their debt. It becomes harder to service your debt in periods of recession or slowdown. And so the dollar will naturally rise. So that's why I was surprised that it got this low. But with a major bullish divergence around 100, psychological level of 100, this is not a surprise to me. This is only a surprise to inflationistas that don't understand what's going on with the dollar. Now, this move is maybe played out because we are overbought here on the RSI. It can get significantly more overbought, say up to 75 or 80. But this is right now, let's see, what are we at today? 72. So we're getting close. We are getting close to a possible top for, the short term. It'll go down a little bit, come up a little bit, but the end game for the dollar is not lower. The end game is higher. Other currencies are going to fail before the dollar fails. So in the meantime, the dollar is going to rise. Once all these other dominoes fall, once the euro falls, once the yuan falls, once the Japanese yen falls, Once all of these other economies and currencies are garbage, then the dollar will follow. But until then, the dollar rules. The dollar rules. And that's a hard thing for Bitcoiners to understand. Um, I'm really the only Bitcoiner out there that talks like this. Um, but that's how the global financial system works. If we take a look at gold, gold was up on the day. Is this a new all-time high? Let's see. I mean, it tapped the high today. What was the high today? 2685, and the high here was 2685, 58, 41. So this is 17 cents lower or off an all-time high today in gold. But I mean, just look at this chart. Compare this chart to the dollar. Okay. Green day or up day. I don't use colors on my chart because of psychological effects, but up day on gold, up day on a dollar, up day on Bitcoin. What? What? What else had an up day? Well, let's go down to S&P 500. Green day on S&P 500. What? Bonds. Down day on yields, but price of bonds is inverse to the yield. As yields go down, the price of bonds is going up. So this is an up day for bonds as well. So bonds, stocks, Bitcoin, gold, dollar, all up on the day. What other macro analyst out there is going to be able to explain to you how that's possible? They can't. They can't. So anyway, let's take a look at this 10-year a little bit closer. Of course, we have the China bazooka here. This one is the Fed cut down here. You see the Fed cut really put in this bottom for the 10-year. Actually, it bottomed the day before, but China bazooka just added to this Fed cutting. China bazooka, boom, look at that. So why are yields going up when the Fed is cutting? The yield goes up when the Fed cuts because the market gives the Fed the benefit of the doubt. They say, okay, you are going to be able to captain this ship to a soft landing. You're cutting rates. You even cut 50 basis points. You could have cut 25, but you went big. So we think it might work. So they have a little bit of optimism. Yields rising is optimistic. It's not what most people say out there, that rising yields are a danger. I mean, look, if there's a spike in yields, yes, but if the yields trend and go up and go to 10%, that's extremely good. That's an extremely good sign. That means the economy is going gangbusters. And people can afford a 10% interest rate because they can reinvest that, expand their business, make other investments. They're making them 20%. So they can take out a 10% loan. But when people are not able to afford that because the economy is slowing, yields will be falling. So if you add the Fed cuts, the kind of grace period of optimism after the Fed cut, add in the China bazooka that people think is extremely stimulatory, you have this period where the market, and we had the payroll beats right here. You have a period where the market is optimistic. But pretty soon it's going to realize that this isn't optimistic. I say yields will rise with optimism, but this will only be temporary. And now we see some big down days here on the yields. So that is my analysis of the 10-year. How about oil? Oil's back down after the Iran missile strike had some uncertainty in the market, some people scared about what the ramifications were going to be. So the oil price did go higher, did not even make it back to $80. Could we call this a higher? I mean, compared to this right here, this little bump, I'll take this off. It is a higher intraday high, but is it a lower close? Let's see. Yeah, no, it's actually a little bit higher close. So this was a little bit higher high, very marginally from the late August high, but overall, this does not invalidate the general trend that we see here of the price of oil just going this way. Demand is going down. OPEC is even coming out saying they reduced their forecast for 2025 demand, say just very by a very small amount, like a couple 100,000 barrels per day or something like that. But on the grand scheme of things, if they're saying that, if they're admitting that, which they don't have, that's not in their best interest. In their best interest is not to say demand is falling, because what are people going to do? They're going to front run. They're going to go out there and short it. So we have um, OPEC is admitting something that's not in their best interest to admit, but demand is falling. Peak oil demand is what we're talking about here. But yeah, we can see this. We'll see if this can hold. Let's draw a line here, so when we come back and check in on this, we can see. I have to see where that wick is, but we could just go like this. Okay, so we'll see if oil can hold that line, if it can hold $69. If not, it's going lower. I think in 2025 we could see $50 a barrel, but we will have to wait and see. Okay, and the S&P 500, I mean, nothing significant to report. This is our kind of line that we will be in a bear market. Maybe I'll have to move this up to here, but for right now, we're keeping it right here. Orange trend line going higher. Didn't even test that. Let's go down to regular C. Now, didn't even test that on any real time frames. There we go. Oops. So, when we start crossing some of these lines, then we're going to know to come back and revisit our theories. But for right now, what we're in is a pre-recession trade. Pre-recession. Market is slowing. When market is slowing, people are starting to seek out safe and liquid assets. Okay. Is S&P 500 safe and liquid? Not really. I mean, people wouldn't say that the S&P 500 it's a risk on thing, right? Like stocks are supposed to be risk on, but not all stocks are made equally. That's why you have the FANGs outperforming, and you have the Magnificent Seven, that dirt bike. Somebody's having a lot of fun out there. That's why the Magnificent Seven outperform, because those stocks are seen as safe and liquid. So as we are going, and that's why they outperform. I had a chart here I found earlier today, and let me make this bigger. See if I can. I was looking this up for the blog post I wrote today, so we'll go over that real quick. Let's see what this looks like. Okay, so S&P 500 versus the Magnificent Seven. All right, so the Magnificent Seven is in dark green, and this year it is 49% for the Mag 7. If you look at the total S&P 500, it's here at 14%. And when was this published? This is not current. This was published back in July. So there you go, halfway through the year. But if you look at only the bottom 493 stocks, it's only at 7%. So see, most of the gains are in the Magnificent Seven, in a very few stocks at the top. And we expect that if we are in a slowdown. If we're in a period of growth and inflation, then the love will be spread everywhere. Everything will generally rise at a similar pace. But when we're in a period of slowdown, people are narrowing where they put their money into safe and liquid assets. So we should see bonds rising. We should see stocks, the indices rise because of the top few stocks. We should see gold and Bitcoin going up, and also the dollar. So that's how I bring this back around, square all that. Okay, so that is the market prices. That is the Bitcoin price. Let me go back to the Bitcoin chart, and then I'm going to check comments and see where you guys are at today. Florida Bitcoin. It's a good day in a good week, in a good year, in an incredible decade. True, man. True. I love the optimism here. Tomek, what's going on? Florida Bitcoin. Nobody is noticing oil. They're still not driving around. I dare to say optimistic. I still think we're in the back half of a recession currently. Okay. Back half of a recession. I mean, are you saying that from like the back half of COVID? Like comparing to like 2014, the back half of the great financial crisis? Um, okay. I can see that. Um, but I think we're still pre-recession. Like this coming recession is not going to be like the COVID recession. It's going to be more similar to the great financial crisis. And so, well, maybe not even that. I don't know. I'd have to go back and look at what kind of recession I'm thinking is the base case, because great financial crisis is when everything broke and there was an existential crisis. I don't think we're necessarily going to have an existential credit collapse this time. It's possible. I mean, look what's happening in China. That's what's going on right now in China. Um, but also, maybe uh, something you're feeling is like from the great financial crisis all the way to today, we have never recovered. So if you look at it that way, I would say, yeah, we're in the back half of that recession, all the way from 2008 all the way to today. We have never recovered. Many places have not recovered. I mean, look at Japan, look at Europe. Those places have not recovered from the great financial crisis. So yeah, I would say that in that case, if you're looking at it like that, yeah, we are in the back half of recession. Dex Invictus, what's going on? Okay, you say just an incredible, noticeable economic slowdown for most working Americans. Okay, cost of living is eating a lot of folks' lunch. Yes, I totally agree with that. Totally agree with that. It's getting tight for so many people. Um, I would say it's starting to bite. Even like the upper middle class is starting to bite them. People are, after COVID, you get these stimmy checks and you go out there and you buy stuff you shouldn't buy. You get in debt, and now you're here. Maybe you are your company is like thinking about doing layoffs, and you're like, oh crap, like how am I going to pay for all these toys I bought? How am I going to pay for all this stuff that I've now committed to? Maybe you got your kids into certain sports, or have racked up these bills somehow, and because you had all the stimmy checks and stuff in COVID, and now it's like the rubber's meeting the road right now. A lot of people are starting to feel it. I'm not a doomer, just talking to a lot of folks in business of all kinds. Yeah, I know you're got your business going, and so you are talking to people a lot more. A lot more than I am. I'm on the internet talking to people, and you're doing it in real life for sure. Um, so anyway, all right. Let's take a look at what I wrote this week. And this is the wrong tab. So I'll go to the proper story here. I wrote something a little bit different today, but we were talking about macro there, so I wanted to bring in a few thoughts from this post. So if you guys aren't subscribed, 182 people watching, mostly on Twitter, probably jump over to the YouTube or Rumble links. Those are in my most recent tweet, but also in my pinned tweet, so you guys can find that. Also, check out the Telegram t.me/Bitcoin and markets, and you can join us there, cutting it up. I am the contrarian Bitcoiner, if you will. I'm a deflationist, and I think Bitcoin is going to be globally adopted, but the environment that it gets globally adopted in is not going to be that fun for most people. So it's not like Bitcoin fixes this. It does fix it, but uh, it fixes it by regression, not by progress. Um, and that's because money evolves, and money has evolved into being credit based money because we're in a unique geopolitical moment, the Pax Americana. And now that brief geopolitical heaven that we had for 75 years is breaking down. And so the credit based money that we have is not going to be fit to purpose anymore. And we're going to regress to commodity money because trust will break down and all of those things. So that's my overall one paragraph thesis of why Bitcoin is going to take over, what we can expect for the global financial system, and all of that. But anyway, today I wrote about the Buffett indicator. And this is kind of random, but I saw a few people talking about it on Twitter, and I wanted to write my thoughts of why it is could be useful still. A lot of people are saying, oh, like I'll go to the chart of it real quick. So here's the chart of the Buffett indicator. So 100 over 100 is supposed to be like overvalued for the stock market relative to GDP. Um, Under 25 is supposed to be undervalued. But you can see here, since the great financial crisis, we're just up and to the right. And people are saying, oh, look how the Buffett indicator is saying this is the most overvalued the stock market has ever been. It's in the time for a huge crash, XYZ, right? But all the stuff I just talked about, you can probably tell that I don't agree with that. So I wanted to break this down. I'm not a huge Buffett fan. Like I think, isn't Preston Pish? He's like a big Buffett guy. I'm not a huge Buffett guy, even though I am from Omaha and I'm born and raised there, and that is Warren Buffett country. But I've never been a huge Warren Buffett fan. Anyway, it's widely been used to gauge if it's overvalued, fairly valued, or undervalued. Sorry, undervalued, fairly valued, or overvalued. But there's been market evolution over the last 50 years. So let's take a look at that. I just introduced the formula: total market cap of the stock market divided by GDP times 100. Oh, it's below 75, not below 25. So below 75 is undervalued. 75 to 100 is fairly valued, and above 100 is overvalued. So we have been above 100 for a very long time. But there are some limitations to this indicator. And the Buffett indicator has been in unusual territory for the past decade. Following the great financial crisis, it dipped to 50%, but rebounded above 100% by 2014 and didn't even fall below that threshold during the COVID crash. So again, even during the COVID crash, it did not get out of overvalued territory with that singularity that we had. That's kind of crazy. According to the Buffett rule, the stock market has been extremely overvalued for a decade, but that cannot be the case. I mean, you cannot say this after this COVID crash at the bottom, the market was overvalued. That's kind of ridiculous to even say. So anyway, there are known limitations to this indicator, and we're going to cover those. So the mainstream explanation is that artificially low interest rates make stocks appear more attractive relative to bonds, leading to higher readings that would typically signal overvaluation. However, we know, if you're a fan of this show, we know that rates are not artificially low. They are low due to macroeconomic conditions, specifically dollar and credit shortages in a credit-based system. These tight financial conditions periodically cause financial crises and push investors towards safe and liquid assets. That's why I was talking about the pre-recession period. In a slowdown, more and more people are being pushed into safe and liquid assets. Okay, and the top stocks are seen as that increasingly. While stocks are traditionally not seen as safe and liquid, certain large cap stocks have gradually taken on that role. which is why we see a concentration in returns from the few at the top. And there's that chart we talked about. Globalization and sector specific dynamics also complicate the indicator's interpretation. Many large companies derive significant revenue from international markets, making their valuations less tied to US GDP. Limitations of GDP itself. While GDP is generally accurate on a quarter to quarter or even a year to year basis. Now, even this statement is kind of heretical in Bitcoin. GDP, CPI, all these things are fake numbers. But I think it's generally accurate. It's not perfect. There needs to be some different, like, private sector alternatives to GDP. We need to come up with something. But it deviates over longer time frames due to the varying productivity of different types of investing and spending. So GDP treats all forms of spending as equally productive, whether from a private sector or government. However, the economic value generated by these expenditures can differ significantly. Private sector investment predicated off private sector spending. So you're going to invest in something that spending is going to pay you back for, right? So it's investment predicated on private sector spending is typically aimed at efficiency and profitability, directing resources towards the highest potential returns. In contrast, government spending, by definition, does not. Well, I messed that sentence up. In contrast, government spending is by definition not what the private sector sees fit to spend money on, and therefore not the most efficient or profitable uses of that spending. This leads to a discrepancy in the actual added value to the economy that compounds or accretes with time. These distortions become more pronounced as government spending constitutes a larger share of overall economic activity. So this is the problem with GDP. It counts government spending on par with private sector spending. There needs to be a discount, whether it's 75%, that would be good, 80%. They need to take private government spending and give it a haircut, give it a discount versus private sector spending. Okay. Usefulness of the Buffett indicator. After examining both the numerator and denominator of the Buffett indicator, it's clear that the measure's components have shifted since it was originally designed. The numerator, market cap, is now prone to overvaluation in times of rising uncertainty as a narrow group of large stocks serve increasingly as safe havens. Meanwhile, the denominator, GDP, is distorted by overestimated economic growth over the long run. Nonetheless, the indicator can still offer valuable insights. The stock market distortion, in my view, is more pronounced than the GDP distortion. So even though they're both distorted in a similar direction here, so the numerator is larger than it should be, and the denominator is also larger than it should be. But I think that the stock market valuation is more pronounced than the GDP distortion. Meaning the Buffett indicator readings are likely to rise over time as investors treat a small group of well-known stocks. Okay, given this trend, it is noteworthy that the current reading is only now surpassing the peak reached during the 2020 COVID crisis. And so if we go back to this chart, if each time as the market is deteriorating post GFC, evolving away from credit-based money, more and more dysfunction in the credit-based system, so more and more people are seeing that those top stocks as safe havens, then we should see this like this era here, post GFC, when it's just going up and to the right. But here we have COVID and we had this big drawdown here. And so we should be way up here. We're actually behind schedule, is what I'm trying to say, according to my interpretation of the Buffett indicator. All right, back down here to considering the broader macroeconomic dysfunction, example, solving debt problems by issuing more unproductive debt, we should expect each crisis to push the overvalued reading higher. So instead of 100%, it should have been up to 150, and now maybe should be up to 200. Anything over that would be overvalued. As more investors seek safety in a narrowing field of assets. And another thing I kind of thought of when I was writing this is, one of the reasons why the mortgage-backed securities became so popular back pre-GFC was because there was a shortage of collateral. So the financial system was expanding, the shadow banking system was expanding, and it needed a lot of collateral. Well, you can create collateral in a few different ways in that scenario. You can rehypothecate more. So instead of having like, I borrow this from you and you borrow this from me, and um, bank D borrows it as well, and there's this chain of borrowing and collateral. You can extend that chain from 7, 8, 9 to 10, 11, 12, and that effectively increases the amount of collateral in the system. It doesn't increase it in times of crisis when everyone's trying to rush for the exits and they are left holding an empty IOU for some US Treasury or collateral, whatever they're using. So what did they do? Well, they created Treasury like securities in the mortgage-backed securities that were supposed to be AAA and all this stuff, because they had a shortage of that. That's why they became so popular. People were seeking out more safety, and so the mortgage-backed securities alleviated the shortage, or tried to. It partially was able to alleviate the shortage in the short term, but of course that all went to hell. So it's similar right now. There's entities out there, people, large funds, sovereigns. They're out there almost subconsciously trying to find safety. Okay, trying to find less and less risk taking, more and more safety garnering, and Bitcoin is perfect for that. Bitcoin is perfect for that. Gold is too. That's one reason why we see gold at all-time highs as well. Um, but Bitcoin is perfect for that. Of course, these top stocks are also good for that. Mag 7. I mean, they're better than holding cash or whatever the case. So uh, that's what I would say. The Bitcoin is, this era kind of reminds me a lot of like 2006, maybe, in that people are out there searching for safe and liquid assets. And so they get pushed into these things, just like we started the show off with. How can the stock market, bonds, the dollar, gold, and Bitcoin all be up on the day? And I'm not saying this is limited to today. This is limited to this period that we're in right now. But how can that be the case? Well, because everyone's kind of, all of those things are considered safe and liquid assets. People aren't. What's the inverse? So I kind of hit all of the freaking sectors, right? All the different. Well, I don't know what the term is. All the different asset classes. That's what I was looking for. But we not really. I mean, there's real estate, commercial real estate, and residential real estate. Those things aren't doing well. People aren't fleeing towards them right now. And we also have just private business. That's such a big component here. Mom and pop, even say a small factory, small, medium-sized businesses. Those small and medium-sized businesses are not expanding. They're not taking risks. Okay. They're probably looking for ways to slim down, to take some risk off the table, to pay off some debt, maybe fire a few people, right size their workforce. Instead of downsize, they say right size now, whatever. That's what they're looking for. So all of those other assets that I said are pumping. It's because the small and medium businesses are not pumping, and neither is real estate and that kind of stuff. So anyway, let's finish this up. Therefore, the fact that the Buffett indicator is just now exceeding the 2022 high does not necessarily signal an impending crash, but rather indicates that we are at the beginning stages of being overvalued. So again, let's take a look at this chart. We're right back here, but each crisis we should be higher, have higher overvalued. So once we get up to maybe 240 on this this Buffett indicator, then we can start saying, oh crap, yeah, we're overvalued. But we got a long way to go. A long way to go on this. So anyway, that's that post, guys. Join the email list for free, bitcoinandmarkets.com. I'm going to take a look at the chat here, and then we're going to bounce for the day. So let's open this up. Tomek says, if you have some time, can you talk about the euro and what is its problem? Yes. So the euro is the problem with the euro is that it's a political union without a fiscal union. And so they all have their own budgets. They all have their own deficits and their own government debts and stuff like that. And there's no fiscal union. They all have their own thing. That's why we see like Italy getting in trouble. The pigs got in trouble because they just had too high deficits, and the market was starting to flee from their government bonds for other government bonds like the German bunds. And so that was the big problem. So overall, the euro is going to break up. I think for that reason, it's dysfunctional as a currency. But even if you say, okay, it's dysfunctional as currency, it can still last as long as the political dysfunction is fairly low. Okay, so if everyone's happy and growing, then you can have some fiscal dysfunction mixed in there and it's fine. But it's fiscally, or the currency itself is kind of created poorly. And now on top of this, you have a lot of infighting starting. I mean, just look at the European Parliament when Viktor Orban spoke the other day. How tense was that? It's like an 8-minute speech that I watched the clip of. It is so tense over there in the European Union. Everyone's going into recession or in recession. Everyone's losing people. The demographic crisis is locking in future degrowth for everybody. Even not, like they don't even have to consciously do it. It's just going to be degrowth. So as that happens, there's going to be a lot of political dysfunction, and if you don't have a strong currency behind that, it's not going to last. So I can see the minute someone starts leaving the European Union, like say Hungary gets out or Poland or something like that, then you're going to see major disruption in the financial union as well. All right, next one, Dexavicus. Buffett doesn't even use the Buffett indicator. Yeah, I don't know the history of it, I guess. Let's see. I'm pulling up the Wikipedia page for it here. Buffett proposed the metric in the Fortune essay co-authored by journalist Carol Loomis. Now, this is Loomis, not Lummis. In the essay, Buffett presented a chart going back 80 years. See, this is a problem, okay, guys? If we have an evolution of the market, you don't want to look at things that are 80 years. I had a section of that post that I ended up taking out, and it was about, I do not like these long-term charts. I've seen this on George Gammon. He looks at the like real estate and he goes back to like 1860 or something like that. I mean, that's crazy. That's crazy. We live in a completely different world. All right. So all of these products and the market itself, and even the money. I mean, we're Bitcoin podcast here. Even the money is all evolving. Okay. So going back 80 years, that's not, you can get lucky. You can get lucky. But 80 years, no. We're way different than we, as a market, as an economy, as we were 80 years ago. But anyway, Buffett said the metric still, it is probably the best single measure of where valuation stands at any given moment. So when was that? 2001? Let's take a look at the chart. Where would it have been in 2001? So let's go down. I mean, yeah, this is when it's starting to break. Okay. So overvalued by a lot And he's saying this back in 2001 during the dot com, and he was proven right. Okay. And here it was over 100. It was a little bit overvalued, but this is when everything broke. The great financial crisis is when everything changed, um, majorly. That a shortage was now the default position in the economy versus right here where you can add credit, you can add some productivity by adding credit. In this era now, there is no, like, diminishing marginal returns on credit have reached a point where there really isn't any productivity by adding more credit. But that's how they try to get out of the credit problem, is, a debt problem, by adding more debt. That's not that, it all changed in the great financial crisis. So in this article, when he came up with it back in, or when he at least publicly stated something about it in 2001, yeah, it kind of worked until then. All right, kind of worked, but not anymore. Okay. That's that. Let's take a look at more comments here. Any comment on ETF flows? Yes. Um, the highs have all coincided with market tops. Also, open interest is very high. Open interest is increasing. I think CME did hit an all-time high, but that I would not say is indication of a top. And for the ETFs, one thing I've been saying is, for the ETF flows, that they will mainly shadow the price. So if you have a plus day on price, you're going to have a plus day on flows. The only time that flows can really have signal for you, in my opinion, is if there is a discrepancy. If we have a negative price for the day or the week, and we have positive flows, then you're like, something's different here. But as it has been, the flows have been positive on every day that the price has been positive. So that's what I would say about the ETF flows. And they have been very positive this week. We can go take a look over here at Farside and refresh. We got the 15th here. So this week has been, let's see, 550 on Monday and 370 yesterday. I bet today is also going to be a pretty big number, but probably less than that. I would say about 150, 200. But yeah, some really big positive days now. Almost 20 billion total inflows. These are some big days back to back. But anyway, okay, that's that. Let's see what else we got here. Credible Crypto just posted that the high open interest is because of leveraged longs, not shorts. That could be the case. But right now, I mean, we can look at where is it? We can look at the heat map here, and we can look at the symbol. Let's see what they say here. In short, it predicts the price. Okay. Liquidation event occurs when traders' positions are closed, but what do they count? Let's see. Liquidation levels based off market data and different leverage amounts. Okay. Okay. So if there were a lot of longs being opened up, we should see liquidations below the price heating up. Let's go out to the 2-week. Just take a look at this. I mean, we have this zone down here, 387 million. I mean, that's not significant, really. It's just significant because everything else is so low. Let's go out to the 6-month. I'm not seeing a lot of these things. And maybe this heat map doesn't necessarily register that, but what you're talking about. But we can see there's not a ton of long liquidations at all down here. All the activity is up here at shorts. And it could be also, don't forget, it could be that those are shorts that are trying to hedge the squeeze. So if there is a huge spike in open interest and it's a lot of long exposure, it could be shorts trying to hedge. Um, I don't know. Uh, I'm not a super technical trader or anything like that. And so I'm just saying that we can't necessarily think like I just looked, longs don't look that overexposed. Um, it looks pretty even. You can also look at the commitment of traders and let's see. I haven't looked at this in a long while, but this is, I'm doing this barcharts.com one. I think Block has this as well. Let's see if this comes up. Is it still thinking or something? All right, let's go back and see. I don't know which one to try here. Uh, I thought Block had one. Let's see. Okay, so this is CME. Large open interest holders of CME futures, not really spiking or anything like that. Open interest of CME futures by trader category. So we have the highest is asset managers, but we have other coming in here. I think that would probably be like retail. Um, Retail could be, yeah, it looks like maybe they're increasing their long exposure right now, but it's being offset by asset managers. Open interest of CME futures by trader category. Okay. Hedge funds have the most open interest. I mean, if you look at these two charts, so this one, oh, this is short. Um, okay. So yeah, hedge funds would be short their own positions. But anyway, let's go down here. Net positions of CME, Bitcoin futures by trader category. It doesn't look like anything particularly crazy is happening right now, other than you could say this other category has kind of spiked over top of the asset managers. Um, but nothing out of the usual there, in my opinion. Okay. Tomek, you say, who is in charge of printing euros? Geneva? Um, no. It's the same as, well, first off, the European Central Bank is in Frankfurt. So just a little bit north there of Geneva. But they're not printing euros. I mean, if you're saying that's who is comparable to the Federal Reserve, yes, that's correct. It's the ECB in Frankfurt, Germany. But no, the people that print the euros are the same as print dollars, and that's the commercial banks in the process of making a loan. You can also say you can print dollars. Banks can also print dollars by rehypothecation of collateral, by extending their chains of collateral, by extending the shadow banking system. Would be a way to print, I guess, at least money equivalent or dollar equivalents or euro equivalents. But no, printing of the euro is done in banks, not in the central bank. But anyway, now Geneva, I don't even know where the Swiss National Bank is located. Is that located in Geneva? Um, or Zurich? Probably Zurich. I bet Swiss National Bank is in Zurich, and they still use the Swiss franc. So, um, anyway, so let's see. Any more comments? Let me check Telegram, see if there's any comments in there. Point. point you say that I should get myself onto Luongo's podcast, shake some sense into him. Uh, yeah, I mean, I appreciate him. You know my feelings point. I'm not saying this necessarily for you, but for the rest of the audiences. I like I do like Tom Luongo's theories, and he's an eccentric person, okay? He's an eccentric person, and maybe I am too, but in my own eccentric way. Uh, and I do have a debt to him for the way he framed certain thing, and that was the Davos man, like the way that to the way that the globalists are set against the people and Wall Street. So those two, that kind of framework was, I think, brilliant, and so I do owe him a lot for that. But yeah, he's just kind of going off the deep end on this oil stuff, just like Luke Gromen, you know. But I put Tom Luongo in a different category as Luke Gromen. I don't know. I can't barely watch any of these macro people anymore. Like I can only even Jeff Schneider I can only watch once a week because one, it's a lot of the same stuff, and two, he just has this gigantic blind spot for Bitcoin, and so I can't get on his program anymore. I wonder if Emil Kalinowski would be more of a Bitcoiner than Jeff Schneider, but uh, he's traveling the world or doing whatever he's doing. George Gammon has been coming around on good stuff, but anyway, that's all I got for that. Let's see any more comments. Oh, you say he's becoming a China bull? What? Tom Luongo is becoming a China bull. Oh man. Yeah, that is, I guess I can see how if you're warped enough to think the opposite of what's happening with oil is happening, that same warping could be warping your vision of US versus related to China, US China rivalry. But now, okay, you included something about Peter Zion here. Now, I am also indebted, or not indebted, but I also am a fan of certain amounts of Peter Zion stuff. And it just is so sad to see people that, I mean, maybe I am like right about one thing and wrong about 10 things, but I think Peter Zion's right about one thing and wrong about 10 things. And unfortunately, he's very right about one of those things. And that is the geopolitical changes that we're going to see, demographics and geopolitics and stuff. Um, but he's very wrong on all things domestic, and he's very wrong on Bitcoin. He's not an economist, and he's kind of just an insufferable human being. Anyway, okay, so that's going to be it. Let me check one more time, see if there's any more comments from YouTube and Rumble. Not seeing anything. All right, guys, I'm going to sign off for the day then. Thank you for joining me. Ansel Linder, Bitcoin and Markets. Join the free email list on bitcoinandmarkets.com. Join us here for live streams Monday, Wednesday, Friday, usually, if there's not a hurricane or something coming through Florida. And if you'd like to support me, do so on bitcoinandmarkets.com. $5 membership goes a long way. So I appreciate everyone that does support. All right, guys, have a great rest of your night. I'll see you on the next one. Peace.